Welcome back to The Explainer. Today we are unpacking a topic that affects, well, almost every single property owner out there, yet it stays completely invisible until it's literally too late. We're talking about the invisible, ticking clock that is permanently attached to your insurance policy. Because look, when disaster strikes, whether it's a massive storm, a fire, or a burst pipe in your kitchen, most of us rightfully focus on the immediate physical damage, right? We just want to get an adjuster out to the property. But as our source material for today reveals, the absolute biggest threat to your financial recovery isn't the physical damage itself. It's the calendar. So let's dive right into this.
So what secretly kills perfectly valid insurance claims? Picture this for a second. You've paid your premiums perfectly on time for a decade, not a single missed payment. Then you suffer a covered loss. You've got the documentation, you've got the proof, you did everything exactly by the book. Yet your fully covered claim is legally thrown out and denied entirely. No way, right? Actually, it happens every single day, and not because the damage wasn't legitimate, but simply because of a single missed date on the calendar. To really grasp how this happens, we need to understand the underlying mechanics of how these insurance contracts actually work.
All right, part 1, the hidden insurance deadline.
Okay, so in the context of property insurance, we're talking about the statute of limitations. This is the incredibly strict, legally binding deadline by which you absolutely must file a lawsuit if your claim is denied or, as often happens, heavily underpaid. And our sources are incredibly blunt about this fact. If you miss this deadline, your claim is dead. Forever. There is no special appeal board, there isn't a regional manager you can escalate things to, there are absolutely no exceptions. Once that clock strikes zero, the insurance company has zero legal obligation to pay you another dime, no matter how wrong their original denial might have been. It is, for all intents and purposes, a fatal deadline.
Moving on to part 2. How long do you actually have?
Well, there's a wild disparity between different states. We pulled this data directly from our source material to really put this into perspective for you. Take Florida, for example. Policyholders there have a 5-year limit to file a suit, which, by the way, was actually recently reduced from 10 years. Then look at Texas sitting right in the middle, offering a 2-year limit. And then there's California, a shockingly short 1-year limit from the date of loss. Just 1 year. Think about how fast a year flies by when you're dealing with finding contractors, arguing with adjusters, and maybe even living in a hotel. A 1-year deadline means the sand in that hourglass is pouring out almost immediately. Now, if you're watching this and you live outside of those 3 specific states, definitely don't assume you have all the time in the world. Our research indicates that a lot of other states set their statutory limits very strictly between 2 to 3 years. So the big takeaway here? You absolutely cannot rely on general advice from the internet. That ticking clock is custom built based on exactly where your property sits and what your specific policy language dictates.
Which brings us to part 3, the date of loss trap.
This is absolutely crucial to understand. There is a fundamental difference between the date of loss and the date of denial. The date of denial is exactly what it sounds like. It's the day the insurance company officially tells you, nope, we aren't paying. Texas, for example, fairly starts their 2-year clock on this date. You get a denial, and boom, you have 2 full years to fight it. But then you have the date of loss. This is the exact day the hurricane hit or the literal minute that pipe burst in your wall. Places like California start their 1-year clock on the date of loss. So why is this such a huge trap? Because your clock is ticking down while the insurance company is still quote-unquote investigating your claim. You could easily spend 10 months just going back and forth with adjusters, which leaves you with just 2 measly months to actually file a lawsuit.
In fact, our sources explicitly warn that insurance companies sometimes delay claims intentionally, just to run out the clock. It's wild, but this is the structural reality of the system. If your policy is anchored to the date of loss, every single day an insurer drags their feet, asking for just one more document or switching your adjuster for the 3rd time or pushing back an inspection is a day that brings your claim closer to legal death. They know exactly when that statute of limitations expires. And if you don't, well, you're playing right into their hands.
All right, part 4, don't miss notice deadlines. You see, long before a lawsuit is even a thought in your mind, there's a rapid-fire sequence of mini deadlines that can quietly sink your claim. It's almost like an obstacle course. First up, day 1. Policies demand you report the loss promptly or within a very specific number of days. If you wait a month just to see if a roof leak gets worse, you might be denied right out of the gate. Next hurdle, the 60 to 90-day mark. If the insurer requests a formal proof of loss document, you have a rigid window to submit this highly detailed, notarized form. Miss it? The claim completely stops. And then the 6 to 12-month window. This is your chance to file supplemental claims if your contractor discovers more hidden damage during repairs. These are administrative traps, and they hit you in the very earliest stages of the whole grueling process.
Finally, Part 5. Steps to protect your claim.
Look, I know all of this sounds incredibly daunting. It's a lot. But the purpose of this explainer isn't just to scare you or point out the traps, it's to give you the exact map to walk safely through them. So here's your actionable 4-step survival guide derived directly from our experts. Step 1. The minute you get your policy, go straight to the conditions section. That is where this sneaky suit limitation clause hides. Find out exactly what your personal statute of limitations is. Step 2. Calendar every single deadline the very day you open a claim. Set alarms on your phone, write it on your kitchen calendar in permanent marker. Treat these dates as absolute law. Step 3. Never let a claim sit idle. Follow up in writing every 30 days. Create a solid paper trail that proves you are actively pursuing the claim. It makes it way harder for them to intentionally run out the clock. And step 4, if you get denied, consult a public adjuster or an attorney immediately, literally that day. Do not wait. Remember, the clock absolutely does not pause just because you're frustrated.
Okay, we're going to wrap up right here. Bottom line, don't let the clock run out. Our source provides a fantastic resource over at claimdefend.line if you want to dive deeper into protecting yourself, so definitely check that out. But I want to leave you with this final, somewhat provocative thought. You probably know exactly what day your mortgage is due, right? And you definitely know when your car registration expires. But do you know the exact day your legal right to rebuild your own home vanishes? If you don't know that answer, I highly encourage you to pull out your policy file tonight and check the fine print. Thanks so much for joining me for this explainer. Stay focused and keep learning.